Well, hello, and thanks for joining us. I'm Jessica Groskopf, Extension Educator and Agricultural Economist with the Center for Ag Profitability at the University of Nebraska-Lincoln. As a part of our center's webinar series, these live sessions are typically held every Thursday at noon Central Time, and you can always find an updated schedule, registration, and an archive of our past webinars at our website, cap.unl.edu. According to the USDA, only 40% of farm households participate in some type of retirement account. For self-employed farmers and ranchers without full-time employees, the opportunity to invest in a one-participant 401k may be a way to save for money, reduce taxable income, and provide potential to borrow from the plan. Joining me to present today is Cory Walters, an associate professor in agricultural economics here at UNL. Hi, Cory.
Hi, Jessica. Good morning.
And we have Doug Nelson, a certified financial planner and adjunct faculty in children, youth, and family studies here at UNL. Hi, Doug.
Hi.
As we get started on our webinar today, I would encourage you, if you have questions, you can put them in the Q&A or in the chat. We will collect those and answer them at the end of today's webinar. Again, a recording of this webinar will be posted on our website at cap.unl.edu. With that, I'm going to go ahead and get some sharing done here. All right, so to kick us off, Cory, I'm going to hand it over to you.
Awesome. Thank you, Jessica. Thank you for the introduction. Our overarching idea here today is to think about where we're going to be with relative to wealth in time in the future. And what we have down here is we have wealth on the vertical axis and we have time on the horizontal axis. And we're thinking about where can you plan to be in the future when you're getting close to retirement in a strategic way. And particularly today, we're talking about how we can move wealth up by taking a strategic decision today. It's not going to necessarily change our path through financially devastating events, but it can move up our wealth to where we can be more comfortable when we get to towards retirement. So the idea is deeper than just making a tax decision. It's about where can our wealth be in the future and planning today. So think of this graph here as just there's no lines on it because we don't know what our path will be. Think of it as we want to have an objective is to have an adequate amount of wealth there in the future, whether that's at the individual level or at the farm business level. We want to make sure that we have an objective and we're trying to achieve that objective. And that's what we have here today is an alternative idea of how to grow wealth into the future to where we can be more comfortable in our decision making. And this is one possibility of many here today. And with that, I'll pass it on to Jessica.
All right, thanks, Cory. So as we talk through today, we understand that traditionally farmers and ranchers really never intend to fully retire from farming or ranching. In fact, an Iowa survey said that about 80% of farmers and ranchers only plan or do not plan to fully retire, and only 20% plan to completely retire, right? But saving in a tax advantage retirement account can be financially beneficial and can help build that wealth. So today I want you to think about maybe retirement versus sunsetting. And by sunsetting, what I mean is there might be events that happen in your life that require you to step back or limit your ability to work in that operation or withdraw funds from a farm or a ranch. So thinking about that, this is one of those moments where we can build a cushion in our financial well-being that would allow us to do that while maintaining a standard of living. So according to the USDA, only 40% of households participate in some sort of retirement account. And this is a really interesting statistic to me because there are tax advantages to contributing to retirement accounts like those we're going to be talking about today. So if you're not contributing to a retirement account, I would really encourage you to talk not only to a financial professional, but also to your tax professional about how we can utilize and benefit from these types of accounts. So there's lots of different types of retirement accounts that are available to you. You might be contributing to a traditional IRA. There are also SEP and simple IRAs available. But today we're going to focus on one participant 401ks. And what's interesting about this is that they come with several different names. So you might have heard it called a solo 401k or a self-employed 401k. And there's some different names that are also down there that you might have heard this type of account talked about. What's interesting about this type of account is that if you are self-employed for this particular type of account, you will be able to contribute both as the employee and the employer. And this has some significant contribution limits to it. And so that really makes it an exciting opportunity that we're going to highlight today. So we can potentially contribute to this account and take advantage from a tax perspective. We can save for those sunset years where we might need to step away from the farm or ranch, either intentionally or unintentionally. And then the third thing we're going to be talking about today is that a one participant 401k also has some loan options that are potentially available in this type of account. So with that, I'm going to hand it over to Doug.
Thank you, Jessica. I thought that statistic about 80% never plan to fully retire interesting. My father is 100 years old, and he was a minister, and he filed taxes with a W-2 at the age of 94. And so, and my grandfather bought a new tractor. He's a farmer, bought a new tractor at the age of 80 on a 5-year loan. We couldn't figure out who was crazier, him or the banker, but he paid it off in 4. And he actually said he made more money after retirement age than he did all the way up to retirement age, because the way the farm prices were. So why would you want to create an individual 401k or one participant 401k? Well, one of them is just to have income that you can pull and access without having to sell a crop or some livestock or sell land. It allows you the freedom to maintain your lifestyle without having to liquidate some of your legacy assets. I know a lot of you probably have heard of a Roth IRA, and that's where you paid taxes up front and the money comes out tax-free. But there are income limitations on Roth IRAs that phase out so that you can't do that. In a profitable year, you may not be able to make a Roth contribution, whereas in a solo K, one participant K, there is no income limit. Of course, tax deferment is a great reason. I'm a basketball coach. I say taxes are like free throws. You don't want to miss free throws. Well, in your financial world, taxes, you don't want to pay any more any sooner, and you always want to look for ways to save. And this is a great way to hit some free throws. As Jessica mentioned, there are some pretty significant contribution limits that a SEP or a simple IRA or a traditional IRA restrict you from putting money away. You can really put a significant amount away. Also, you can consolidate retirement assets. There may be, we'll get into that a little bit later, but you can roll IRAs, 403Bs, other 401Ks into one vehicle to manage more efficiently. And as you go through retirement, having fewer accounts is sometimes easier to manage as you get older. There's loan options, and then we'll talk about that, and also bypassing probate. You can have assets that are non-qualified, but if you haven't set up your estate plan, it may be tied up in probate or incurring legal fees. But by having it in an IRA or a qualified plan, it's like life insurance. It goes directly to your beneficiaries. So we'll talk about each one of these individually. So first of all, who can establish it? And the first thing you need to know, even though it says one participant 401k, it not necessarily is limited to one participant, because a spouse can be involved in these as well. So a husband and wife team can both have the advantages of being able to shelter a significant amount of money. But if you end up bringing on employees, there are some restrictions. You may not be able to have a solo K if you have full-time employees. So you must offer it to someone who is over 21 and has worked 1,000 hours in a 12-month period, or 500 hours for 3 consecutive years. So if you have part-time employees, you want to be mindful of those are the restrictions on hourly basis that you, per year. So that might impact how you hire out your part-time help, if this is something you want to do for you and your spouse or your operation. There are some employees that are exempt. You can hire people that have not aged 21 or have not completed a year of service, or if there could, this isn't really probably relative to many farm operations or ranch operations, because most employees are not in a collective bargaining agreement, but I want to make sure that you know about that as well. So how much can you contribute? Well, right now, 2024, you can contribute $23,000, and over 30,500 if you're over age 50. Your combined, now that's your employee. As Jessica mentioned, you are considered an employee and an employer. So as the employer, you have the options to do profit sharing and add additional money that could go up to as far as $69,000, and even higher with the catch-up contributions. So we're talking about a husband and wife team that are over age 50 that conceivably could be putting in almost $140,000 pre-tax, which is a pretty significant tax savings. What is considered earned income? And this slide kind of, that's the IRS definition of what earned income is. And yes, you do have to pay self-employment tax on this. And that's maybe one reason why a lot of individuals balk at doing this, because you do have to claim this is as Social Security and Medicare tax. But that's not necessarily all in all a bad thing, because what we frequently find, I don't have the statistic for this, I probably should look into it, but what the average Social Security benefit is for a farmer or a rancher, because so little income has been claimed. I mean, over time, you spend a lot of work with your accountant to show no income. Well, at some point, it'd be nice to get a check every month from Social Security. And don't dismiss how significant that check really is. If you use what we call the 4% rule, that someone has a bucket of money they want to take out money from every year annually, they can take out about 4% a year in a 60-40 portfolio and never run out of money. So let's just say someone's Social Security check was only $1,000 a month, which is fairly low. It's below the average. That's $12,000 a year. That bucket that Social Security represents is $300,000. You would have had to have saved $300,000 to get that $1,000 a month on using 4% withdrawal rate. So it's not necessarily bad that you actually put some money into your Social Security bucket. You do get to subtract out 1/2 of that self-employment tax when you figure out your income. And just to put it in more easy to understand terms, the next slide will show you where that income is located on Schedule C. Y'all are familiar with Schedule C. Whatever you get on line 31, that's the number you can use to draw your income. However, if you are putting in the 23,500, that lowers your income for tax purposes. Significant tax savings available to you. Another advantage is there's filing deadlines that are advantageous with the individual K. If you're using a traditional IRA, you have until April 15th. If you have a simple 401k or a simple IRA, you have to make your contributions by December 31st. With the solo K or one participant K, you have until the filing deadline for your taxes. And this is really an advantageous option. For example, I have my own practice, and when I do my taxes, I take my taxes to my CPA and I say, okay, how much are my taxes going to be? And then I know then I say, well, how much if I make my maximum contribution? I can do that after the taxes have been figured out and before I file. And I can actually delay making my contribution for 2023 all the way up till October 15th of 2024, which allows me to earn some income during this year to take care of last year's taxes. And giving the sways in profitability year to year with farming and ranching, that's a really good perk to have. Now, in the initial year of setting up an individual 401k, you need to set it up by December 31. But in the first year, you have for your employee contribution all the way up to that October 15th filing date. The profit sharing going forward, your employee contribution has to be made in the calendar year, but the profit sharing component that the employer can put in, that still is delayed until your filing date or extension. And depending on how you're set up, your entity type, you may be going earlier. S Corp, you're looking at March 15th and September 16th. But either way you look at it, it's good to have the ability to make changes in your previous year tax filing by doing something in the current tax year. So I mentioned the phase out on Roth contributions, and setting up your one participant K with a Roth option allows you to, in a great year that you might have, still contribute to a Roth. But I highlighted married filing separately because many times it may be advantageous to file separately. Maybe you weren't married the entire year. There might be student loan reasons why someone wants to file separately. And if you're in a married filing separately and want to contribute to a Roth, that phase out is really low. I would guess that most people couldn't contribute to a Roth if they were married filing separate on their tax form. So an individual 401k is a great advantage for those individuals who are filing separately on their tax form. I mentioned about loans. This is a great opportunity to explore. You can borrow up to 50% of the loan value or $50,000, whichever is less. And you have 5 years to pay that back. It's even longer if you're doing it for the purchase of a home. Typically, your interest that you pay will be tied to a federal rate plus points, but that money typically is going back into your account. So it can almost be looked at as like a CD or a fixed account or money market investment. So you're paying yourself back. Obviously, you're paying back with after-tax money. So that you need to consider that as well. But I've run into situations where farmers need to borrow money for their seed, for their crop. They go to the bank for that. Maybe an option might be for their individual 401k to fund that and not have, and maybe get a lower interest rate, and that interest rate goes to themselves. if your account is less than $10,000, you can take 50%. If it's less than 10,000, you can take the amount out. If it's between 10,000 and 20,000, you can still take 10,000 out, even though it's more than 50%. Anything over 20,000, you get 50% of that to be taken out.
So Doug, when we compare this to other types of retirement accounts, do those other types of retirement accounts have loan options, or is this unique to the one participant 401k?
They're unique to 401ks in general. 403bs and 457s typically will have a loan option. You're not able to borrow against your SEP if you have a simple employee pension or a traditional IRA or a Roth IRA. Those loans options are not available on those routes.
And does every one participant 401k have a loan option, or is it something that we need to check into?
You need to check with your provider. Some providers may not offer that option. So that's where it's really important that you sit down with your financial professional and explore the options available. Some that are really low cost, and you can do these direct. You don't necessarily have to go to a financial advisor to do it. But if you're doing that route, make sure you check to see if you can have the loan. And maybe you have an incident coming up where you need a loan, and this kind of goes into the portability issue. You can roll money from an IRA or from another retirement plan into your individual 401k to maybe get more balance built up to take from which you can take a loan. So I mentioned that these distributions bypass probate. If you have money in the bank, money in the stock market, and a brokerage account, assets typically have to go through probate unless you have established a trust. The IRA or the 401k essentially is a trust, and those assets do not have to go into a trust when the owner dies. You can go directly to whom they wish to send that money to, without having to go through the trust and the probate process, which could be a significant savings. One caveat is you really need to look at your beneficiaries on a regular basis. If some life event happens where there's a divorce or a death or someone falls out of favor, you should do an annual review to make sure your beneficiaries are up to date. I've run into situations frequently where someone went through a divorce and never got their beneficiary changed, and then got hit by the Budweiser truck, and all of a sudden all the assets went to the ex-spouse, and the current spouse really has no recourse in that situation.
So I think Doug mentioned this earlier, but I think it's really important that as we talk about these opportunities to think about our wealth, that we really need to bring together a really strong financial team. And a lot of times, we've talked a little bit about a tax professional today. We also talked about a financial planner, but we also might need to be talking about this with our lawyers as well as our bankers. So this is just one opportunity for farmers and ranchers to explore new paths for retirement accounts and potentially some of that sunset planning. So with that, I do see that there are a couple of questions already in the Q&A. So I'm going to open those up, and we'll start there. But if you have questions, I would encourage you want to type them either in the chat or in the Q&A. We'll go ahead and go through the chat. So Doug, the question is a crop share landlord, this is a crop share landlord, can their income be counted as earned income for a solo 401k?
First of all, that's an accountant question. As far as earned income, it depends on how they're structured, and the involvement that the landlord may have in the operation. And whether it's passive income or earned income is really strict definition that needs to be addressed by your CPA, your tax accountant. I'm not a CPA. I'm a certified financial planner, and by law, I'm not designated as someone who can give tax advice. I can do tax planning, and this is why it's important to have a team involved.
Here's another one for you, and it might fall kind of along the same lines. So proceeds to beneficiaries would still be subject to inheritance tax. Is that correct?
Well, I know that I think in Nebraska has an inheritance tax. I actually live in Kansas. So I'm not familiar with taxes law in Nebraska, though I think they have a rather low inheritance tax as it relates to farmers and ranchers compared to the federal tax, which is per a couple almost, it's over $20,000, around $24,000. A couple in Nebraska, and Cory, you might be more in touch with this than I, but isn't the estate tax around $3 million? So a couple would need to have about $6 million before it would be subject to that inheritance tax.
I'm not sure what the number is, but it's up there somewhere.
But money coming out of the IRA is going to be counted as income. It's going to be income taxed. So I guess the short answer is no, it's not inheritance tax, it's income tax.
So again, just taking that opportunity to go back to those advisors and ask these questions directly of them. Again, we highly recommend that you're talking not only to your tax accountant, but also potentially to a certified financial planner. I'm not seeing any other questions in the chat. I would encourage you, if you have those questions, if you will get them in now.
One thing I'll just, while they're closing up, you mentioned one came in on the Roth contribution. So the contribution to the Roth and the traditional, you can choose to do both, but the employee contribution is still limited to that 23,500 or 30,500. So one might choose to do 10,000 traditional and then another 13,500 into the Roth. What's great about this is that you might want to look and see how much traditional you want to put in to stay in a lower tax bracket, and then take, for example, if you're on the borderline between a 22 and 24% tax bracket, you may want to put enough in the traditional to stay in that 22% tax bracket, and then put the rest into the Roth. More details on the Roth contribution. I want to talk a little bit about the backdoor Roth contribution, where someone who does earn too much to make a Roth contribution, if you have multiple IRAs and you set up an IRA just to do a backdoor contribution, you would have to do what's called the pro rata. It's like putting cream into a cup of coffee. You'd have to figure out how much of the was original coffee and how much was cream. So you want to make sure that if you're doing a backdoor contribution, that you only have one IRA. Well, a lot of times people will have other IRAs sitting around, and you can't pick or choose which one you have it come from. It's looked at all of them. You can roll all those IRAs into your solo K and make it simplified, so that then you just open up a short-term IRA and do the backdoor contribution. I don't know if that answers the question on Roth contribution, but one advantage would also be with your traditional Roth contribution, you have to make that contribution by April 15th. Whereas if you have that embedded as an option into your individual 401k, you can make that Roth contribution all the way up until your filing extension date. That would be another option to look at. The recording fee, the cost to file 5,500. Unless it's over 250,000 in the account, you do a 5,500 EZ, which is a pretty simple little. It's very simple. It's easy. That's why it's called the 5,500 EZ, and there's no fee on that unless you're using your accountant to do it. And it's typically not that expensive in the big. If you have over $250,000 into the account, it's very minimal to justify doing it.
We have a couple of other questions that were in the chat. So one of them was, does a solo 401k require a contribution every year?
No. And it kind of goes into the other question on profit sharing with the solo 401k. When we talk about the employee and employer duality of the individual 401k, that employer part of that is the profit sharing. That is the profit sharing. And in a good year, you can put money in. Typically, it's going to be 20% for of your profit online from your taxes or your earned income. But that's the profit sharing component of it. Roth contributions are taxed up front, but not when they're, so yes, it's like any other Roth. You will have to pay your taxes up front, but there's no taxes on the back end. Can a Roth IRA be rolled without penalty to a one participant K? I was just looking that I believe not. You can roll a one participant K to a Roth, but I don't think it works that both ways with a qualified plan, accepting a non-qualified plan. I don't recall Secure Act 2.0 made some significant changes, but I'm not sure if it addressed that one. That would be a good accountant question.
Can you talk a little bit more about the profit sharing with a solo 401k? So again, going back to that employer and maybe a little bit more about that employer contribution and how that functions.
So typically you'll take, for example, take your self-employment tax off of, you get take your income, do your self-employment tax, you deduct half of that, it comes out to 20% of your income, up to that limit of 69,000. So someone would have to have a lot of money to get to the 69,000. But so if you only have $100,000 of earned income, your contribution could be $20,000.
Are the Roth contributions taxed? And I think you answered that a little bit already. So if you want to just go back and re-hit, how are Roth contributions taxed?
Roth contributions are taxed up front. You make that contribution. It's just like a Roth IRA. You've already paid taxes on it. You put it into your investment bucket that's got Roth on it, and when anything that comes out of it is not taxed.
This is a good question, and I like this question. Are you required to draw money out of a 401k each year after retirement?
Okay, it depends on whether it's Roth or traditional. Until Secure Act 2.0 went through, even if your money was in a Roth, you would, at your age of required minimum distribution, you would have to take money out as an RMD. But 2.0 designated qualified plan Roth accounts is exempt from the required minimum distribution. That used to be, I advised people who were even using a Roth in their retirement plan to keep a bucket open or have a Roth IRA. So when they hit that required distribution age, they could roll that money over. But now that's not necessary to do that. So, but yes, your traditional money is treated like a regular IRA. And if you were born before 1960, I think your RMD date is now 73. If you're born after 1960, your RMD date is 75.
Cool. I think our final two questions kind of go together. Do you have a list of documents to establish and maintain 401k? Or is that something they need to work with their financial planner and tax accountant on?
Well, the document's going to will be set up through your custodian. So if you're using a mutual fund family or an investment advisor, or you're going direct to a broker, they will have the paperwork for it. I should have just included the attachment on to establish and maintain it. Again, those are going to go through your custodian. You will need to set up it's a pretty simple process. You'll need to set up an ID, tax ID for the plan. It can be done online. You'll have what's called a summary plan description or document, and you'll elect different features you want to have. You will elect whether or not you want to have a Roth option. You will elect whether or not you want to have loans as a possibility. You will decide how you're going to, what funds you're going to be able to invest in. If you're with a mutual fund family or with a company that bundles mutual funds into the product, you may be restricted to just those investment options. If you do it through a clearinghouse, you may have ETFs, stocks, alternative investments as options. So you want to, if those are important to you, that should be part of your decision making. Also, the fees and expenses are built into that. Are you paying commissions for someone to manage this, or do you feel like you can do it yourself, but you'd like to have someone guide you through it? Or are you going to drive it and navigate yourself? There's all those options you'll want to explore. So I would just encourage you to do some research. I also encourage you, I should have pulled it up. Just the IRS website is a great tool, and there are special documents just for farmers and ranchers and for small business employees that I encourage you to go to the IRS website. What I've learned over time with dealing with IRS documents, that people get intimidated by all the wealth of information that's there, but it realistically, it's written about an 8th grade level, so most people can understand it. It's just intimidating, and most people just get glass-eyed when they look at it. But if you take your time, the IRS website is very, very helpful. I have my students use it in my classes all the time, and you can pick the topic, you can search what you want to explore, and I'd encourage you to use it.
All right, I'm going to do one final call for questions. I'm going to be adding some of those resources to the chat here. So one final call for questions.
Am I still there? My battery went down. Okay.
Yep, you're still here.
All right. My screen went blank for a minute. Sorry.
No problem. Well, it doesn't look like there's any more questions coming through the chat. We would like to thank you again for joining today's webinar. Look for a recording later this afternoon in the archive section of the Center for Ag Profitability's webinar page, cap.unl.edu/webinars. When you exit the Zoom, you should see a short survey, and we would really appreciate your quick feedback on today's webinar and ideas for future topics to cover. Thank you again, and have a good afternoon.
Bye. Thanks.